Right now, there are two types of investors in this market: the ones who think they're diversified and the ones who actually are. If you own an S&P 500 index fund, you are almost certainly in the first group, and the gap between what you believe you own and what you actually own is wider than at any point since 1972. That gap is where the next major loss is going to happen. And it is also, if you understand what I'm about to show you, where the next major opportunity is hiding. If this is the kind of analysis you want more of, the stuff that doesn't make headlines until it's too late, hit like right now so this reaches people who actually need it. Here is the fact that changes everything. 10 companies currently represent approximately 40% of the entire S&P 500 index. The other 490 companies share the remaining 60%. That means if you invest $10,000 into a standard index fund today, $4,000 of it, without you choosing it, without you knowing it, goes directly into the same 10 mega-cap technology names that everyone else already owns. The index presents itself as diversification. In reality, it is a highly concentrated bet dressed in the language of safety. And this matters right now, in a way it did not matter 3 years ago, because the macro environment that made those 10 companies the best place to be has structurally changed. In 2021, interest rates were near zero, inflation was quiet, and technology companies with earnings weighted toward the distant future were valued at a premium by every model on Wall Street. That world is gone. Inflation is running above 4% by the OECD's most recent projections. The Federal Reserve is trapped. It cannot cut rates without risking inflation acceleration, and it cannot raise them without threatening growth in a fiscal environment already stretched to its limit. Oil prices are structurally elevated. Geopolitical disruption has fractured the supply chains that globalization spent 30 years building. In this environment, what you own matters more than it has in decades. The sectors that have structural tailwinds from these new conditions will significantly outperform those that don't, regardless of what the headline index does. This isn't theory. In 2022, when the S&P 500 fell 15%, energy, infrastructure, and defense stocks delivered returns of 30 to 50%. The money didn't leave the market. It rotated. The investors who understood where it was rotating captured those returns. Everyone holding the index watched their account go sideways and called it unavoidable. It wasn't unavoidable. It was predictable, if you knew where to look. And right now, the same kind of rotation is beginning again, which is exactly why I want to show you the specific framework I use to find where institutional capital goes before the move becomes visible, and the 3 companies sitting at the center of it. Drop a comment right now. Are you currently holding index funds, individual stocks, or both? I want to know where you're starting from, because it changes which part of this analysis matters most for you. The framework starts one level above stocks, and this is the discipline that separates institutional capital allocation from the way most retail investors actually make decisions. Most people start with a stock. They hear a name, they read an article, they see a ticker moving, and they try to figure out whether to buy it. That is the wrong sequence. You start with the macro environment. You identify which sectors benefit structurally from that environment. Then, and only then, you go looking for the specific companies within those sectors where the capital flow data, the earnings trajectory, and the technical evidence of institutional accumulation are all aligning simultaneously. Skipping the first 2 steps means evaluating a boat without knowing which direction the current is running. You might pick a great boat, but if it is moving against the current, it does not matter. The macro environment I just described points to 2 sectors with unusual clarity right now. The first is energy infrastructure, and I want to be specific about the distinction between the trade that has already happened and the trade that is still in front of us, because they are not the same. The obvious trade, buying oil producers when oil prices are elevated, already happened. The exploration and production companies spiked in the early phase of the geopolitical disruption. Institutions were largely already positioned when retail money started flooding in. In many cases, they were sellers into that spike. Sentiment drove the move, not structure. That is not the trade. The real trade is the picks and shovels layer, the companies supplying the equipment, machinery, and services that make energy production and infrastructure possible. These companies benefit from elevated energy prices because high prices justify capital expenditure, but they are not exposed to the day-to-day volatility of oil itself. Their revenues run on long-term contracts, multi-year infrastructure build-out programs, and sustained capital spending from producers who need their services regardless of what happens to price on any given week. And here is where the setup becomes structurally unusual in a way that has no direct precedent in recent history. The AI build-out is creating an energy demand surge that the existing infrastructure was not designed to handle. Data centers running large language model training and inference consume power at a scale that is straining regional grids across the country. The natural gas processing and export infrastructure providing a significant share of that power is operating at or near capacity. Grid modernization to connect new power sources to where demand actually exists requires sustained, multi-year capital investment. Every one of those constraints is a spending cycle, and every one of those spending cycles flows through the balance sheets of energy infrastructure and equipment companies. The specific name with the most direct exposure to this thesis is Baker Hughes, ticker BKR, one of the world's largest oilfield services companies, with active development of offshore LNG terminal infrastructure and a backlog that its most recent earnings call specifically tied to the persistence of geopolitical disruption in critical energy corridors. But the more asymmetric opportunity, the one where potential return relative to current valuation is most imbalanced, is in the smaller, less covered players within the same ecosystem. Companies providing site infrastructure and services for large-scale energy and industrial construction projects are showing 80% institutional ownership, strong buy consensus from the analysts who cover them, and a technical pattern, months of sideways consolidation, repeatedly testing the same resistance level that is consistent with the kind of base building that precedes a directional breakout. This is where understanding how institutions actually enter positions becomes critical, because it is the opposite of what most retail investors expect. Institutions do not buy at the bottom. They buy on breakouts, when a stock clears its resistance level with volume meaningfully above the 20-day average. That expansion of volume is confirmation that buyers are stronger than sellers at that price. It is evidence of directional shift, not anticipation of one. When those levels are exceeded in these energy infrastructure names, the setup I am describing becomes active, not before. Share this video with one person right now, someone you know who is still fully invested in an S&P index fund. Not because what I am describing is bad news, but because what comes next is the part most people never hear until after the move has already happened. The second sector carries what I believe is the most asymmetric opportunity relative to how widely it is currently understood, and the fact that it is almost entirely absent from mainstream financial coverage is not an accident. It is the signal. The sectors that receive the most media attention are, by definition, the sectors where the marginal investor already knows the thesis. The opportunity there is already priced. The opportunity in undercovered sectors exists precisely because the marginal institutional investor is just beginning to discover them. And critical minerals, the physical materials required for electrification, advanced defense systems, and AI infrastructure, are in that early phase right now. Here is the structural reality that makes this sector one of the most important allocations of the next several years. Lithium demand is growing at approximately 25% annually, driven by EV adoption and grid-scale battery deployment. Copper demand from electrification applications is expanding faster than the mining industry can currently build new supply. Uranium, and this is the part that most commodity analysts are not adequately modeling, is experiencing a genuine demand renaissance. Nuclear power is the only baseload energy source capable of replacing fossil fuels at grid scale without intermittency. AI data centers are increasingly being built with nuclear power as the intended primary source. European nations that decommissioned nuclear capacity following Fukushima are now restarting it. driven by energy security imperatives that became impossible to ignore after 2022. The current production base cannot satisfy the demand trajectory that these converging forces are creating. The defense dimension adds a layer of structural demand that compounds every other thesis in this sector. The advanced weapons platforms and electronically sophisticated defense systems that define next-generation military capability require rare earth elements and specialized minerals that are currently produced predominantly in China. The United States government has explicitly identified this dependency as a strategic vulnerability and has mobilized $30 billion in financing to accelerate domestic critical mineral production. That is not market-driven demand. It is policy-mandated demand, backed by federal financing, with a multi-year timeline that does not move with quarterly earnings cycles. The three names positioned at the intersection of these demand streams are SQM, Sociedad Química y Minera de Chile, one of the world's largest lithium producers, actively expanding production capacity and deepening its partnership with Chile's state-owned mining company. UEC, Uranium Energy Corp., which has just brought online the first new U.S. uranium production facility in over a decade, operates 2 active mining sites, has processing capacity of 4 million pounds per year, and sits in direct alignment with the government's strategic interest in domestic supply independence. And MP Materials, a rare earth and minerals company approaching a technical breakout where the volume pattern and institutional positioning data suggest the accumulation phase is reaching completion. 3 names, 3 independent demand drivers, 1 converging structural thesis. Now, and this is where I want to slow down deliberately, because getting the analysis right and still losing money is more common than most people admit. Structure is not sufficient on its own. The framework tells you where the opportunity is. Risk management determines whether you actually capture it. The most consistent failure I observe among investors who correctly identify structural opportunities is position sizing. They concentrate too heavily, driven by conviction and the frustration of watching from the sidelines. Then when volatility arrives, and it always does, they exit at the worst possible moment because their position is too large to hold through the turbulence. Even the greatest gold bull market of the 20th century included a 47% drawdown between 1974 and 1976. The investors who held through it captured the full move. The ones who sized incorrectly were forced out at the bottom. The discipline that separates the investors who capture structural moves from those who identify them correctly and still fail is not analytical sophistication. It is 3 things: maximum risk, calibrated to what you can lose without being forced out by emotion, entry only on technical confirmation that institutional buying is active, and the patience to hold through the volatility that every multi-year structural move generates, because these things do not resolve in a straight line. Baker Hughes, SQM, UEC, MP Materials, these are not trades built around a news cycle. They are positions in structural trends that are still in their early stages. The energy security investment cycle has years of capital expenditure ahead of it. The critical minerals demand surge from electrification, AI infrastructure, and defense applications will compound for the better part of a decade. The investors who enter these positions at current levels, size them appropriately, and hold through the volatility will look back at this moment, this specific period in 2026, as the window where the opportunity was clearly visible to anyone willing to look one level below the surface. Most people will not look. They will keep watching the same 10 stocks the index pushes them toward, assuming the diversification is real until the macro environment makes the concentration undeniable. The S&P 500 is 40% concentrated in companies whose valuations were built for a world of zero interest rates, low inflation, and frictionless global supply chains. That world no longer exists. The capital that has been flowing mechanically into those companies through passive investing will rotate, it always does, and it will rotate into the sectors and companies that are structurally aligned with the new environment. The question that actually matters is not whether that rotation will happen. It is whether you are positioned before it becomes obvious or after everyone else has already moved. If this breakdown gave you clarity on something the financial media isn't covering, and I think it did, consider subscribing. This channel is built around finding where money is actually moving before it makes headlines. No noise, just the analysis that matters before it becomes obvious.